The core rate in the United States staying stubbornly high. Housing costs pretty stable. And then we've also been seeing a move up in goods prices, or at least goods prices not dropping as the Fed might want it to see, or stay stable. Let's bring in Michael Green, Chief Investment Strategist with Simplify Asset Management. Great to see you once again, Michael. Thanks a million. Talk to us about the core inflation. Is that worrying the market right now?
Well, I think the market is consistently worried about the core inflation number because of the concern about whether this is a secular increase in inflation or whether this was transitory, as has been a term that is now largely derided. What's happening in the U.S. inflation numbers, it's actually quite interesting. If you were to normalize the U.S. CPI metric to, say, EU standards, we'd currently be printing about a 1.6% inflation rate. The reason that inflation remains elevated, in particular in this core metric, is because of the mechanism that the U.S. uses for calculating housing inflation. That metric was correctly derided in 2021 as people recognized that things like owner's equivalent rent, et cetera, did not capture the nascent inflation that people were seeing in rents and home prices and mortgage payments. It unfortunately is now lagging on the backside. And so I would hope that the Federal Reserve is looking through this. If we use more recent metrics that they have developed, things like the all tenant rent index or the new tenant rent index, those are suggesting that number should come down very sharply over the next several months. But to be fair, they've actually suggested that for the last several months. So we're just not that flow through yet that we would anticipate if we have a proper understanding of how these metrics are supposed to work.
So the Fed may be overcautious on inflation, in other words.
That's certainly my interpretation, and it's something I was worried about as we came through the summer, that we were ultimately looking at two separate factors. One was this issue of the lagging OER component, the owner's equivalent rent. The second is a seasonality factor. And so people remember last year at this time, as inflation prints began to come in slightly hotter than expectations in U.S. markets, that in turn discouraged expectations of aggressive Fed cuts at the tail end of 23. And those actually manifested in a delay in the Fed choosing to cut, and cutting perhaps less aggressively than had been priced in. A similar dynamic is in play now. Companies that had historically, for the past 5, 6, 7 years, had not considered raising prices on an annual basis are now suddenly starting to post through price increases on an annual basis because customers have gotten used to it. And so this is going to be one of the key questions we have as we go into 2025. Do we actually see a significant change in pricing behavior amongst corporations? Does that show up in higher than expected seasonal adjustments? And how much of an offset does the loosening of the U.S. housing market, that's kind of unequivocal at this point, when does that actually start to flow through the data and provide some cover for the central bankers in the United States and elsewhere around the world?
What do you mean by cover? You mean a justification for lower rates?
A justification for it, right? Because what we've seen at this point, we've now seen a couple of prints that are in this kind of 2.6 to 2.7 range. That suggests that the pace of improvement in inflation has slowed dramatically and is raising a lot of questions about whether the Fed should be as aggressive as their supplemental forecasts would suggest that they should be.
Give us your thoughts on President Trump. A lot of things get said on the election trail, and he's famous as a negotiator, or he likes to say he's a brilliant negotiator. So not all of his rhetoric will translate into policy, presumably.
I think that's right. And, Peter Thiel famously said people take Trump literally, but not seriously. And so his literal statement is tariffs are a negotiating tool. I'm going to put 20% on and 60% on the rest of the world and 60% on China, and they're going to be forced to come to the table. That is very much a literal interpretation of what he's saying as compared to a serious interpretation, which is candidly that the U.S. has largely ignored its trade policy and has basically said, we're going to adopt free trade and assume everybody else comes along. When an entity like China chooses to manage their currency and export their surplus production to the rest of the world, that is no longer free trade, right? That is actually effectively a mercantilist policy that is being thrust on the American and candidly the Canadian worker for that matter. And the US is simply saying, as the largest customer of China, we actually have the power to negotiate. That's really what Trump is saying. He's basically saying, you're either going to start buying more of our stuff or we're going to start penalizing you for dumping your surplus supply into US markets. All else being equal, I actually think that's a very positive component. How that flows through to inflation is uncertain, right? If China chooses to retaliate as it did in 2018 by hiking tariffs on soybeans, which is the US's largest export to China, that would be a sign that we're going to see more fractious behavior. On the flip side of it, an analysis was just done that looks back at the 2018 tariffs and acknowledges that about 75% of that was eaten by Chinese manufacturers in the form of lower margins. I would be surprised if something similar didn't play out here after a period of adjustment for the very simple reason that China really doesn't have that much negotiating power. It has to sell because of a deficiency of domestic demand. And if it cuts back on production, it in turn is actually impacting employment, which is going to be far more important to China than almost anything else, runs the potential for unrest, et cetera.
And part of your analysis is that last time around, China was the one that absorbed the cost of these tariffs, or the bulk of it.
And unfortunately, I think they will again. If you look at what is what really happens, it is U.S. distributors or wholesalers like Amazon and others who are importing from China and selling to U.S. consumers. All the Trump administration is effectively saying to Amazon is, look, you're free to source from wherever you want, but we're going to raise the costs associated with sourcing from China in particular and export it and our foreign trading partners relative to U.S. trading partners. Whether that manifests itself in a return of manufacturing to the United States, candidly, I'm very skeptical about it. But on the flip side of that equation, it does actually have a tremendous impact on China and importantly, the resources that China can then command on the global stage. I honestly think that's part of what you're seeing in oil prices. If you go back 2 or 3 years ago, the expectation was all about China's reopening was going to propel oil demand to new all-time highs. Clearly, that's not happening.
Just want to touch on something. Under the Biden administration, as you know, there's been a massive amount of investment in spurring manufacturing in the United States. Incredible, like trillions of dollars in total incentives for various programs, including clean energy. Is that a bit of a mirage? Has America's day as a global manufacturing powerhouse gone, or will they be able to restore a lot of industry?
I would be very surprised if the U.S. returned to a global manufacturing powerhouse on the back of American workers becoming competitive on a cost basis with Chinese or others. The United States has some unique attributes as it relates to things like agriculture and other components. Canada obviously benefits from those as well. But the simple reality is that the feature that exists, we effectively are Rome within a global empire. The costs within the capital city are always going to be higher. And so it strikes me as unlikely and implausible until we make the leap to much more automated production processes. And the spending that you're describing within the Biden administration, just an unbelievable fraction of it was wasted, particularly on the green energy components. But really, all of that emphasis is in critical technologies, things like semiconductors, the CHIPS Act, et cetera, that are effectively trying to bring critical supplies back to the United States, recognizing the risk that's created to the United States by having an extended supply chain with a potential rival featured prominently in it.
We could talk to you all day. Michael, you'll have to come back more often. Thank you very much indeed. And interesting that you had the analogy there of America as the Rome within a global empire. Perhaps ominous, because Attila the Hun showed up after a while. But thank you very much indeed.
Thank you.
Michael Green, Chief Investor.